we're waiting to hear results from Apple, Ford, and Starbucks, just to name a few. Oh, yeah, there we've got all those logos for you populated Monday through Friday. Those reports should offer a closer look on consumer spending in the economy that is slowing. Our next guest saying that he's unimpressed with what we've seen so far this season and things might get a little worse. Joining us now with his take is Howard Silverblatt, S&P Dow Jones Indices Senior Index Analyst. Unimpressed, Howard? Okay, what would it take for you to be impressed?
Not unimpressed, but we've beaten the 77% of the issues have beaten the estimates, but the estimates were lowered over the last 6 weeks. So if you measure them against where they were 6 weeks ago, we had a slight miss. But bottom line is that we do have decent numbers. It's not an earnings recession. The cash flow seems good. We have about 64% of the dollar values in so far. And so the numbers are good, but they're nothing to write home again. Going forward, the guidance looks a little bit shaky at this point. The high assumption and optimism that the Fed will stop at the 0.25, consumers will start spending again, and built into the second half here is that companies will again be able to push through all their cost increases, plus maybe a little bit more to increase the profits, with the second half expected to be 12% up. That's a bit optimistic at this point, and we are paying for that on high PEs. So it's not that earnings are doing bad, but they're not doing as good as the majority of the street right now is pricing in.
So, Howard, I got to ask you, you said not an earnings recession. You brought up the R word. So what is your prediction? Does it remain the same about when we would potentially or could potentially see a recession?
Well, I think we've already seen and are in a selective recession, depending upon your economic group as well as the sector that you're in. Going forward, I do see more pressure on consumers. They are being more selective. They're reducing the costs, and costs are still going up slowly, but going up, especially materials. And we're seeing some variances in energy and transportation costs on there, which are very volatile. Energy, by the way, is one of the standouts for this quarter. They're contributing about 9.6% of the earnings. They only make up 4.6%. So they're doing a good job there. But as far as the earnings going forward, again, the optimism for the second half is very high. And I think the profit numbers are much too high at this point, showing an 11% margin. Historically, we're dealing about 8.3%. So again, optimism is very high. And if for some reason the Fed continues on past the 25 basis points, or consumers continue to be cautious and selective on their earnings, those numbers are going to be reflected in the earnings for the second half. And we're going to have to redo the PEs.
So it's largely been, if I can summarize it correctly, according to your perspective, it's been relief that we've seen even some of the rallies, post-earnings beats that were, of course, on some of the lowered expectations. So is there still resiliency that you're seeing in some of the companies right now, especially within tech, which we've seen become extremely just volatile or gap up one way or the other after earnings? They've been highly reactive. So what would that signal to you? What does that set up for a company like Apple that reports this week?
Yeah, tech definitely has been very profitable on that, representing about 19% of the index earnings. Financials, by the way, 20% at this point in time. We haven't had as many reserves or losses on there. But definitely the companies are able to push through on products consumers want. Again, I used that word selective recession before, but a lot of the consumer products out there that tech is associated with add to the day-to-day convenience and enjoyment of people. And they are spending on that and pulling back in other areas. So again, technology does seem like they're very profitable. The cash flow is good. Going forward, they're expected to do well into the second half, not just the second quarter, but the second half as well. Not the higher numbers that we're seeing overall for optimism, but more sustained numbers. Double-digit gain for next quarter. So again, they seem to have decent product placement and the ability, the elasticity to increase their prices along, and consumers are spending on it.
Howard, in your last postmortem, your previous one, you noted the facts about SVB and Signature being out of the picture. At the time, First Republic was still in the picture. Given what has just occurred overnight from Sunday to today with regard to First Republic, is there any cause for concern about cracks in the banking sector from your view?
Well, not at this point from this morning. It is a concern, especially on a dividend scale, because we expect lower growth in the financials and therefore dividend growth would be less. However, the JP Morgan's up this morning. You see it near a 52-week high, should open up around there. Additionally, we're not seeing the expansion into other regionals out there. Again, additional regulations will be there. Profit margins for the sector, especially the regionals, will be lower. So it's concern, but not the wholesale bank failures that we're seeing at this point. It does seem to be contained. I would not be surprised to see other regionals get into some issues, shall we say, maybe have an arranged marriage over a weekend. But again, these three are three different kind of situations on here. And so far, the financial markets have controlled it. Whether long term it's going to be beneficial or not, we'll have to see. But short term, we've definitely controlled the damage.
Also, this earnings season, Howard, we're going to be watching for, of course, this week, Ford and Starbucks. On one side, you've got the little luxuries for consumers, and on the other side, you have a very financed purchase. Of course, sometimes I do finance my coffee cup, depending upon which one I'm getting at Starbucks. But at the end of the day, financing a vehicle, far more important in the day in, day out for a lot of people. So what will we gauge about the consumer by the end of this week that we haven't already known this earnings season?
Which areas consumers are spending? Are they going for the data? As you said, that Starbucks coffee is a little bit more than the wagon, the trucks on the street, to see if that's impacting it at all. So we'll get a better feeling of where they're pulling back. I mentioned the technology, so a lot of the groups there that consumers are spending. So we need to see, are they moving down into lower retail areas? Are they, what they're pulling back on? We'll need not just this week, but another couple of weeks as the retailers come out with their diagnostics and their reporting on there. But it's definitely consumer time to figure out what they have. We saw the institutions, we saw the banks, which are very important. Some of the ITs, more this week, but the social media ones as well as the retails are going to tell us what the individual, which is the bulk of the spending, where it's going and hopefully where we expect it to go.
Howard Silverblatt, S&P Dow Jones Indices Senior Index Analyst. Howard, thanks for taking up the time and teeing up this week in earnings for us. We appreciate it.